Welcome to the Dividend Talk podcast, episode 126, comparing three European breweries. Hey guys, welcome back to another episode of Dividend Talk. This week we're going to compare three of Europe's largest breweries. It's Christmas. Who doesn't love a drink? All that and more. See you on the inside. Hey, European DJ. How are you, man?
Hey, Derek, I'm doing really well. Actually, it was St. Nicholas this week. So if you don't mind, I would like to start with a little poem because one of our listeners in the Dividend Talk Facebook group was so friendly to ask ChatGPT, the new hype currently going on, to write a poem for us about dividend investing. So if you have a second, let me start. A steady stream of income that grows with each passing year. Dividend growth investing, a strategy held dear. With careful stock selection and a focus on the long term, investors reap the rewards of a diversified firm. As dividends increase and compounding does it work, wealth is steadily built with very little irk. So if you're seeking to grow your wealth with little fuss, consider dividend growth investing. It's a strategy worth to discuss.
I love it. Brilliant.
Uh, uh,
And you said it so well. You delivered that perfectly as well.
Yeah, and it is written by a bot. Can you imagine that, right?
Wow.
It's
Wow.
amazing. It's amazing. We can soon stop as content creators because if they are able to create all of this, then why do you still need us?
Exactly. I mean, you would never you would never imagine a bot being able to write something like this. Like
Yeah,
it's coherent, it makes sense, it does everything you actually need. It's perfect.
yeah. I assume it took it somewhere from websites, right? And then translate. But still, there's so much content already out there. So if it's able to already navigate for us through it, we can just stop with blogging generally.
Yeah, yeah, we'll be out of a job. Not that we get paid for it, but we'll we'll, we'll,
we
we'll be
should,
out on the streets.
yeah, we just need to put a voice on top of it, and then we can actually generate all our shows for the next upcoming 50, and we can have the questions from the listeners when they are not about real time data. We can let the bot answer it.
Yeah, maybe. Yeah, that's our plan for 2023. We're going to hire a bot and see how we go. Moving on. So we have some news this week.
Hmm.
One of the big ones was the CEO from Fresenius Medical Care is leaving. This is pretty big because she was quite new. And
Yeah.
she hasn't been at the helm very long, and now is leaving what they call mutual consent,
Yes.
which basically means that there are some differences that she doesn't agree with and the board doesn't agree with, and she's getting out of there as quickly as possible.
Yeah.
It's quite worrying. I know for seniors, we spoke about them. They're in a bit of a downward trend at the moment.
Yeah.
The business model is quite complex. We know it has lots of different moving parts, but it's definitely concerning to see someone going in there that had such high promise, went in expecting to turn things around or,
Yeah.
or to make some changes, and now has left due to strategic differences, as they call. So it's really really concerning for the company at the moment.
Yeah. And now the CFO was just also in this company for a few years, 2 or 3 years or something like that. Ellen Giza, I believe. She's
Mm.
become the CEO. And honestly, for me, it's always a red flag when a CFO is turning into a CEO and specifically from such a company. Yeah, we
Yeah,
saw it with Shell with Peter Voser at the time. It was also not a great era that people look back at with a lot of joy. Yeah, CFOs are good, should be good in be managing money, but to be a CEO, I believe you always need to really understand the operations of the business. Well, hey, who am I? I stepped out of Fresenius, which was also having a large stake in medical care. So luckily, I won't lie away from it, but it's not good in my opinion.
No, not good news at all. And you're right, the CFO taking over. I think we've done maybe a show on this before. Definitely spoke at length of examples where CFOs took over and make companies worse. You should get engineers in there. I always say that get a good old engineer in there. But it's look, it is concerning, and shareholders out there, I think, will be quite worried, particularly with the share price drop. If you're stuck with them,
Mhm.
you're probably stuck with them now. If you kind of
Yeah.
have to try and ride it out and see what happens. But it's not good news. But it'll be interesting to see how Helen takes over, what her vision is.
Mhm.
Maybe she maybe she'll buck the trend of the CFOs and actually turn this company around. But it's yeah, it's not good for the company, I don't think.
Yeah, and then the second news of the week item for me was generally Unilever Investors Day, and I think I would recommend everyone to at least go to their website, look up some slides to know what you own. I think many of us own Unilever, and generally what I like to say is that when I read the information, it feels a bit more focused. So I have a feeling that maybe this hedge fund, what is it? This hedge fund investor, this Peltzer,
Yeah.
is really having an influence here because this cannot. It's simply not possible that Alan Yopi wrote this. I mean, uh, we know his level of idiocy when it comes to this. So I believe that it's getting into the right direction. It is also interesting when they put a picture in there, and I was a bit in conversation with Alexander, who we had on the show on the Dividend Talk Facebook page there, and we were talking about a little bit about how they, in my opinion, squandered 6 billion in sales. So what they have one really interesting picture. They said we sold two brands for, I don't know, 11 billion, and then we bought many small brands, like quickly growing brands, for 17 billion. The sales that they sold for this 11 billion was 5 billion, and the new replaced sales is 4 billion. So they should have higher margin a little bit here, but they should also grow quicker. But it's still 6 billion in cash, right? And if you think about it in the free cash flow that you get out of those nice new brands, it might be like 10 to 20 years of investment before you recover that. So it just shows us how bad the capital allocation decisions were over the last few years. And yeah, I hope we can leave that time behind us. But there was one really, really, really interesting one that picked both our attention, and that was that their dividend goal currently is an attractive dividend. It didn't mention of any growing dividends, so it sounds like they might keep this dividend flat for several more years if we don't watch out, especially if they struggle to grow their underlying income.
Yeah, it's something to watch out for. I mean, I haven't sat down and listened to this. I've flicked through the investor presentation because you've kindly given me the link. Um, Nothing really pops out at me. I did see yourself and Alexandra's talking about this on Facebook, and look, I'm still not convinced that there's a clear framework here. It's a lot of fluff in that presentation. I still don't
Yeah.
see a clear direction, but I think it'll take time. There are signs that maybe this hedge fund is starting to take control. It does look at least a lot better, but you're right. Alan Yopi definitely didn't write this, but I'm still not seeing something here that's telling me where they're turning this around,
There's
where
nothing
they're
yet to
growing.
get excited about.
Yeah,
Yeah.
yeah.
Plus one to
So that,
that.
yeah. So look, we'll see. We'll see. I have my eyes on it. But I still really think Alan needs to go, and until he goes,
But he will go. So,
yeah,
yeah.
yeah, sooner rather than later. But
Yeah, true.
let's see. Okay, onto our main topic. Actually no, we'll do some dividend hikes beforehand. Nearly forgot about those. And actually some big ones this week again. ABM. I don't know if you have ABM.
No.
12.8% increase. Mastercard 16.3% increase for them dividend hike.
Wow. Low yielder, high growth.
Oh, I mean, it's up to a Visa, and a Visa and Mastercard are the
Yeah.
two big
Top
ones. I know
notch.
you have American Express as well, but these are the
Yeah,
two that
exactly.
I really want to own one of them, but who knows?
Yeah, I was
Uh,
close to owning Visa at $180, I believe, but I didn't pull the trigger.
yeah. Deere and Company. hiked their dividend by 6.2%. This is actually their second hike this year, so a total of 14.3 in total.
Tractors.
Tractors, farmers, yes, yes. I
Yeah.
mean, I spoke to you before the show. I actually used to think these were an Irish company purely because every single farmer in Ireland has to have John Deere. And I mean, if you don't have John Deere and you're a farmer, you ain't got nothing over here. So I mean, it's a really, I think it's a company with a really strong brand. We always talk about
Yeah.
brands. I think it's one of
Yeah.
those with a really strong brand, and
True.
14.3% dividend hike in the year is pretty good. Morningstar, 4.2%, not too shabby from them. Brocom, which is probably popular with some of our listeners, hiked it by 12.2. And
Hmm.
one of your companies, Bristol Myers Squibb, 5.6% increase. What do you make of that?
Well, it's a bit low compared to the other ones that you just mentioned, but I take it anytime. I take it anytime.
Yeah, I mean 5.6 is not too bad. And then the last one that I'd like to mention is Abbott, and they have their 51st consecutive years of dividend growth, and it was 8.5%. I mean,
Yeah.
we've said it since we started doing this segment. I think what we're starting to see is that the companies with a lot of brand, big moats, and just quality companies are starting to shine through and really pumping out big numbers here. And then we're seeing lots of shite coming through that just can't hold up. So
Yeah.
it's interesting.
But you know, they're still very expensive, most of these companies.
Ah, of
And that's
course.
the issue as well.
Yeah, of
Good.
course.
Our main topic, because I'm getting really thirsty, really, really thirsty, is about breweries. And this was a much requested topic for the show among our community. I mean, you got to give it to Europeans, but you know, we don't do anything before we had our morning coffee and then the weekend before we had our Friday beer. So, yeah, that's Europe. I don't know if Americans always understand that, but that's how it works over here. After at 5 at on Friday, when work is finished, you meet up with your friends, go for a beer. And if you're lucky, you work at a company where you can already drink some beer in the afternoon on a Friday. Yeah, it's not anymore so usual, but I remember the days early in 2000 that the network IT department, you know, at 1 o'clock you saw a 6 pack of beers going in, door was locked, playing you know, what was it Call of Duty on the network there, and then drinking beers. I mean,
To be fair, we didn't really have that in Ireland, but what we used to do instead was just go down to the pub next door, the local pub. So you could go down, it used to be the Monday Club, which was
mhm,
the social day. So you could
yeah,
go down to the pub at, say, between 12:30 and 5 o'clock on a Monday, and it is
yeah.
packed. Everyone having a drink, everyone having a good time. It's crazy. Times have moved on. Sadly, it's not like that anymore. But I think Europeans definitely have more of a culture. It's more of a social aspect.
Yes, yes,
Which I mean, Americans might like to go for coffee. We'll go for a beer, and that's
yeah.
kind of a difference. But hey, look, we've took the top three. I know there's a couple, but we've took the top three, and they all happen to be European, which is good. And we just kind of went over them. So might talk about the biggest one first,
Hmm.
and it is the one that is the hardest to pronounce. So I'll do my best. But it is an Usha Bush Inbev. How did I do?
You can just say up Inbev. Yeah, that.
Yes,
Yeah,
we'll
you
give it
get
the
a
Belgian name.
6 out of 10, Derek.
Yeah.
You're learning. Good job. By the way, off topic. This week we got someone, a Dutch guy, mentioning on Twitter that after all this time, after all this show, he finally figured out who Decline Capitalist is because he thought it was Decline Capitalist, like in a declining mode. So it took a bit
Uh,
of a while because the pronunciation. So that's off topic, but it was funny to hear.
my apologies. I do my best. I really do my best.
I know. I really love it, actually.
But this company is quite interesting. It's got a steep history, hasn't it? Like we were looking at all the mergers over the years. I think it was formed back in the 1800s, and now we're looking at it's an American and a Belgian company combined, are headquartered in Belgium. It's really, I find it really complicated to try and follow where all the moving parts came out of. But essentially, was it back in 1970s or in and around that, or was it 2000? In the 2000s, we got Anoush Bush, Inbev, and Sab Miller combining to create this big giant company, and
Mm.
they own 31% of the market share worldwide at the moment, which is quite something for one single brewery.
Yeah, and then they have like what is it? The brands Budweiser, Corona, Stellas, but also Hoegaarden and Leffe.
Yeah,
These are quite some, some iconic beers. Even I would say, and I think Budweiser is famous for the commercials in the Super Bowl, right?
yeah, the three
Yeah,
frogs, the three
yeah,
frogs is the big one. Yeah, look, they've
yeah.
got some really big names, lots of names there as well that I don't know, but they look like they could be big in likes of Asia. And like
Hmm.
what I like about this company is they've got truly a worldwide presence. Like they
Yeah,
seem to be all over Australia, Asia, the whole lot. They're on the Belgium Stock Exchange, as we said. They're
yeah.
on New York Stock Exchange, Mexico Stock Exchange, which I thought was quite weird, but even Johannesburg as well. So you can see that they're trying to cover everywhere. So they got a really good history. But hey, that's enough about their brands. What about their financials? What way did they look to you when you were going through them?
Yeah, there it's where it becomes a little bit, how do you say it, a bit more difficult because I think this company has been struggling after the Sepp Miller acquisition. And we have our own dashboard, right? And for instance, if you look just at the dividend growth, and that's one of the first things we look at, right? Just since 2017, it has been in a decline in dividend growth. So at the moment, it's still paying a 2% yield, I believe. Need to double check that. But yeah, there's just no dividend growth. It has been just declining, 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 declining. So that makes this company already for a dividend investor really unattractive. We just cannot count on it. And it's literally after the acquisition, I believe, or after the merger with Sepp Miller, which is a pity, right? Because beer companies, if there's one thing they have, it's brand stickiness. I mean, you don't easily change your beers like that, right? You
Yeah,
usually fan for quite a long time. So I can go further into it, but you can see even the cash flow, right? The free cash flow was like not going anywhere. In 2012, it was 7.5 billion. Last year it was 8 billion. The year before 5.8 billion. Currently, the 12 trailing months 5 billion. So it went nowhere, even with this big merger in between. Now it's currently trading at a 56, is it euro? Yeah, euro
yeah, yeah,
share price. And if we would take a really high free cash flow here of 9 billion, which is not even realistic, it would then only with a 5% growth rate, 3% thereafter, the next 5 years thereafter, 12.5% discount rate at 60 euro, which then would say it's a fair price, but this 9 billion is just not even realistic, I would say. So from that point of view, if you look from a valuation and also from a dividend safety, our dashboard spits out that it is a questionable, borderline questionable slash unsafe. So in my opinion, that's the pity about this one. The largest brewery in the world, but probably this is where we typically would say a good company, but a very, very poor stock. And that's a
yeah.
pity.
It is a shame because you look at the top line, and the top line seems to be slow but steady increasing over time. There are a few dips, but as you said, that merger with Sab Miller, that was in 2015. That's
Yeah.
what's that's what's crippling these guys. The amount of debt that they had to put on the balance sheet for that alone, which is over.
Yeah.
I mean, goodwill makes up nearly 65% of their balance sheet.
Yeah.
It's just too much. Now, to their credit, they are paying down that debt quite fast. They are
They,
trying
they,
to
they
pay it
have
down.
to. They have to.
Yes,
I mean, even just, to show how bad it is, if you invested in 2016 because you're hyped around the merger, you would have bought it for like 115 euro and it's now trading at 57. And
yeah.
we're talking here about almost 7 years later.
Yeah, but they've still paid off in that time 25% of that debt. So if they keep going with that, maybe this could be a long-term play. Maybe not from a
Yeah.
dividend or dividend safety point of view, but as soon as we start getting that debt down to where they have a more manageable level, maybe we're looking at
Yeah.
about 39, 40 million or so on, maybe then they could be a good play. But I still think they need to clean up that balance sheet before we can even think about dividend safety with these guys. Which
Yeah.
is a shame, as we said. They have got some great brands. Look like I think it's a growing business. I know beer, particularly in Asia, but you also got these zero brands as well that these are pumping out. So there's a lot of growth potential, but they just need to get that depth under control, and then we can think about dividend safety from there.
Yeah, exactly. Exactly. So unfortunately, the first biggest how you say it, brewery that people are asking about as well, up InBev, not gonna do it. So let's go to the second one, which is Heineken. Now, Heineken, of course, is an iconic Dutch company, I would say. Who doesn't know Heineken and who doesn't know it's from the Netherlands? The company was founded in 1864 by Gerard Adriaan Heineken in Amsterdam. It currently has or owns over 165 breweries in more than 70 countries. And it has 348 brands. I believe Up InBev has more than 600 brands, but 348. I mean, they need to have a whole catalog, digital catalog there, even because nobody will remember so many beers in a single company. But of course, Heineken is the big brand. But you have got Amstel. I don't know if you know Amstel. It's quite well known also in Western Europe. Desperados. I think you can get it in many countries at the moment. Krušovice, Sol, I believe you pronounce it. So these are really some big brands. Now, if we look at it, they are currently, if we look at 2021 numbers, right, they did 21 or 22 billion in revenue, which is quite a lot. But what for me the most interesting here is if you want to own Heineken, what is really important to know, the Heineken family holding, let's say, they still own 50%, and it really is slightly a little bit more in this company. So as a shareholder, it's family owned. From one side, that's really good because it really aligns with the long-term investor mindset. On the other end, it depends really on what the family is interested about. Yeah. And this is also here again an issue with the dividends, I would say, and we'll get back to that soon. But what I think is for all the companies that we are discussing today is like they had a post-COVID boom. That's really important to know. All the companies this summer, it was like really like everyone was out again on holiday, on vacation. Um, Everything was loose, partying. So beer sales were really up this summer. So also you see that in the trailing 12-month numbers. But this is about it as a company again, right? So if we would go to Heineken, let's say more from a stock point of view, then it's an issue because also here, when we look at the dividend itself, it had to cut the dividend, I believe, in 2020 during COVID because they were just protective to the dividend. So it was actually paying a dividend before then in 2019 of €1.65 per share, and then it slashed it to €1 4 last year 98 cents, and this year it hiked it back to €1.20. Therefore, if you look at it from a dividend safety point of view, it's very questionable, much better actually than Up InBev. It has a proper credit rating, right? An A3, so that's good. It has seen free cash flow growth over the years. Payout ratio is really low compared to the earnings that we are seeing now, and the free cash flow that we are seeing now. It's just such a pity that it cut the dividend because honestly, if we look at the balance sheet and such, if we look at the free cash flows, it was simply not needed. Yeah, if we look at the free cash flow, for instance, in 2020, it was 1.5 billion. They paid out in dividends 811 million. The year before, they paid out in dividends 1.2 billion. So 1.2 billion at the depth of the crisis, free cash flow 1.5 billion. It was covered. It was covered. And that's the pity because they work with a payout policy of, I don't know, paying out probably 50% of dividends. And this is what is such a shame because this is for me an example of a company that doesn't need to cut the dividends and could have been such a typical dividend aristocrat. And it was growing the dividends for many years, actually, until that dividend cut. So Really a pity. Really a pity. No, if we want to go maybe then still from an a valuation point of view, our fair value says that it should be trading around 60 euro based on a 5-year average free cash flow of 2.5 billion, taking the same growth numbers, the first 5 years 5%, 3% thereafter at a discount rate of 12.5%. It's trading at 90 euros. So for me, way too overvalued. If you think about having Heineken having like a bottom, a floor in the dividend, I think it's still paying out a dividend that you could say is almost a multi-year floor, right? 1.2, 1. So if you find the dividend then attractive, you could buy it. But again, here the dividend payout rate, the dividend yield at the moment is 1.6%. So it's also not a dividend that makes me happy and to consider investing in. So this is actually second company, I believe, right? Great
Yeah.
company, poor stock.
Yeah, and I mean, it's as you said, it's a pity because the brand, like everybody knows that big red star. You see that in front of
Yeah.
anyway. You know they're selling Heineken. It's has such brand power. My concern with them is that they have half the market share
Hmm.
as InBev, as we discussed, right? So in order for them to try and catch up with that, they're probably going to be involved in some M&A, some
Yeah.
acquisitions, some targeted acquisitions. That's going to cost money. We've seen what that has done
Yeah.
to InBev. So that's my real worry with these guys. And
Yeah.
now that they've cut the dividend, maybe it's not going to be as safe. But again, fantastic company, brilliant brand power, but not a good stock, I think.
Return on invested capital, 14%, more than the weighted average cost of capital at this moment in time. It's just really a good company that is earning money for investors, but not as a dividend growth stocks. Yeah, and
Yeah,
that's really, really the pity here. I can actually look at the 5-year share price. Give me a second. It does there. If we look at the 5-year, for instance, here, then da-da-da. Yeah. Okay, it went nowhere. It was trading at 89 euros 5 years ago and still the same here. So yeah, also not even from a capital gain point of view,
yeah.
it went nowhere.
So such a pity. I mean, if that was a dividend aristocrat, they would be number one in my portfolio, without a
Oh
doubt.
yes, yes,
Without
yes,
a doubt.
yes.
Such a shame.
But we
Um,
always leave the last for the best, right? Or the
yes,
best for the last.
probably the best lager in the world. Isn't that what they say?
Yes.
Carlsberg is our third one. It's actually quite surprising. And one of the questions I was asking you off air is, how can these guys grow their dividend? They're a lot smaller, so they're even half the size of Heineken. So Heineken's half the size of InBev, and then these guys are half again. And their dividend growth record is quite strong, a lot stronger than the other two. Now we have to bear in mind they are a smaller company and they don't have the same global presence as Heineken or InBev. One thing that they do have is they have a stronger presence in Central and Eastern European markets, and also Russia. So it's actually quite interesting to see with what's going on in Ukraine and Russia. They did take a sharp drop in share price when that broke out, as you would expect, but they've recovered quite nicely from that, which is something I did not really expect, to be fair. I know we've seen a lot of,
Yeah.
as you said, post COVID, and we've seen a big jump this year across the whole markets, but I was not expecting to see that, particularly in Russia and Ukraine markets.
Yeah. Yeah. So maybe this is just an opportunity.
Yeah, I think so. I mean, as we said, they are a lot smaller now. They don't have the same brand power or even the amount of products as the rest
Hmm.
of them. They pretty much have Carlsberg, and then they have a special brew in Denmark, which is stronger. They do have other brands which I have absolutely no clue about, in the likes of Bulgaria, Russia, Kazakhstan.
Yeah.
But generally, Carlsberg is their main driver. So in terms of brand power, they don't have the same as the other companies, but I think they have a lot bigger opportunity, particularly in terms of growth, because they are smaller. They've only 6% of the
Yeah.
market share. There's a lot of growth potential, I think, in these guys, and they seem to be well managed. Their balance sheet is fairly stable. their top line is growing, and as you said, they have a really really solid dividend history as well.
Yeah. Yeah, so maybe if we start looking into the stock side of things, this is what I love
Mm.
about Carlsberg. So guys, good news, 14 years of dividend growth. They had to slash the dividend during the great financial recession by 40%. So it shows also that these breweries are a little bit cyclical of nature.
Yeah,
But they were able to maintain the dividend and actually hike the dividend during the COVID crisis, which is really good. Currently, they are paying out from free cash flow approximately 31% in dividends. They have a yield of 2.63% at the moment. And the growth has been good over the last 5 years. Average free cash flow growth over the last 5 years was 16%. EPS growth 12%. So free cash flow was growing a little bit quicker here. But also their credit rating, and that I don't understand. Yeah, we just saw Heineken with A3 and they have BBB. Yes, I would have expected, based on everything we saw about the stock, that it would have a similar credit rating as Heineken. But okay, maybe the credit rating agency sees something more than we see. Let's count on that. But also their interest coverage of 23, no issue at all. If we look at just the free cash flow and the earnings per share development, it's generally trending up. It had a bit of a dip in 2015. But other than that, it all looks good. And what I also really like is that they have been paying off their debt quite significantly. They had like 70 billion in long-term debt 10 years ago in Danish crowns, and now it has been reduced to 32. So they halved their debt over time. And maybe this is also a reason why they had BBB. But at the moment, how you say it, equity is more than it, which is in its history a really good sign for Carlsberg. If we then look at the dividend track record, right? So since 2008, the only way was up. It paid in 2008 still at 3.5 Danish crowns per share. You know what's paying now? 24. That's
20.
that's in 7 or 8 fold in dividends in, let's say, 14 years. This is really, really lots of dividend growth. Their 5-year dividend growth rate is 20%. Yeah, compounded annual growth rate. Unfortunately, the dividend yield is not yet 2.75 yet. It's 2.63. It's really near. I believe it has a dividend policy to pay out 50% of their earnings in dividends. It is good to know that the free cash flow payout ratio, what I just mentioned, is 30% and EPS 47. So I still feel like there's still some growth possible in the upcoming time. Price to earnings currently 18. And yet this company just looks really good. And if we put a fair value on top of it, then the fair value of, let's say, 8.4 billion for this company is the 5-year average, approximately, if I'm correct. Yes, 5-year average.
Yeah.
Using the same growth numbers again, it gets to a 785 Danish crowns. It's currently trading at 913. So this gives us kind of 14% overvalued. But honestly, this is a company that I could own around that fair value price. So if it would drop 10 to 15%, I could own it just to have some beer stock in my portfolio.
Yeah, it's a nice company, and just around that fair value, that's a conservative value as well. I mean, we're
Yes.
not being too optimistic. We've given it a neutral growth rating as well, not even a strong growth
Yeah.
rating here. So we've been really, really, I would just say, cautious with this one.
Yeah.
It's 13% overvalued, but honestly, if it got down maybe even 850, I would still consider
Yeah.
it.
If we take our optimistic case, it says that it's now fairly valued. That's probably good
Yeah.
to mention.
Yeah. But it's for me the Russia, that whole market is my one concern, and just to try and understand the logistics. But I think this has the most growth potential, and as you said, the balance sheet is cleaner than the other two,
Yeah.
because they haven't probably bought as much. But of the
Yeah.
three, it's definitely the one brewery that I would like to own.
So having said that, guys, when you're listening, this was a much requested topic for our show. I hope we really served you well with this one. Generally saying beer should be drunk. Yeah, you should drink beer. You shouldn't invest in beer stocks generally. And if you really want to choose one, we would recommend probably Carlsberg, based on what we have seen today. But of course, do your due diligence while being sober.
Good advice. We move on to some listeners' questions. We have quite some to get through, so we will start with Simon. And Simon has asked us a couple of questions, but the first one is, what are your main learnings for 2022? What has been your big lessons for the year?
Yeah, I saw the question coming in, and I find it hard to answer that one. I haven't really done my numbers yet. I will do that in the first week of January, so probably I can answer better then. But one of the things that came to my mind is like how glad I was that I didn't jump on all these kinds of FOMO stuff like Bitcoin and such. If you have seen that crashing, oh, so yeah. So maybe my learning is that I was able to keep my emotions into control in 2021.
Yeah, one of my biggest ones is quality rises to the top. We've
Yeah.
kind of something similar to what you're saying. We've seen a lot of different cycles, crypto and growth
Yeah.
stocks and all these, and now we've seen the market crashing this year more than what we've ever seen before. But even at that, we have companies like Johnson Johnson, Texas Instruments,
Mm.
and we've
Yeah.
mentioned quite a few that just have not dropped in price,
Yeah.
and it seems to be quality rises to the top. So I think that's my biggest learning of 2022. Stay away from shit stocks and
Yeah.
focus on quality.
Good.
The second one, the dividend world often feels like an echo chamber or an echo chamber. Everyone loving Johnson Johnson and Realty Income. How do you block out the noise and stay impartial?
Yeah, I taught myself how to analyze dividend stocks and screen for them, and I guess that's it. Yeah, and in this case, Johnson Johnson and Realty Income, yeah, I love them as well. Can't help it.
Yeah, yeah. I mean, I think you're right. When you're in a circle, and I suppose the dividend, particularly the European dividend world, is quite small. So you're talking within that circle, and everybody seems to be talking about the same stock. So
Yeah.
I agree with you. It is kind of like a little echo chamber every now and again, but there are lots of gems out there. We try and cover some
Hmm.
sometimes, and you've got blogs like Decline a Capitalist,
Yeah.
who really does cover some gems that are not talked about. So I would how I block it out. Sometimes I don't. Sometimes I don't block it out. But like you, I try to do my own
Yeah.
diligence when
And
necessary.
at the same time, also surround yourself with people that I said are skeptical a little bit by nature and don't overhype stuff. And we see this a lot with American YouTubers and such. If you're and Simon is on the Dividend Talk, how is it, Facebook group and also on Twitter. Most of us, the Europeans especially, they are like no bullshit people. Yeah, and we say it to each other, and we keep each other a little bit also therefore accountable, right? And that's what I also like. So it's hard in
Yeah,
in these surroundings to
yeah.
get that.
And then question number 3 is: have you actually ever voted as a shareholder on company decisions put to shareholders?
I believe one time via Interactive Brokers. Yeah, I don't remember anymore what it was about, but yeah.
No, no, I haven't, because most of my shares were in the Gyro.
Hmm.
They don't give you that option. Now I'm
Yeah,
starting to move more and more of my portfolio is going into Interactive Brokers. That's where all my deposits are going now. So I do
yeah,
get the emails, but I still have not yet voted yet. But
mm,
maybe that's a goal for 2023.
yeah.
Um, Marek has asked us a question: do you feel FOMO when growing stocks or crypto goes to the moon?
Um, yes, because I've never been on the moon yet.
I mean, we are human. I think it's hard to shut off
Yeah,
completely, isn't it? When you
mm,
see 16-year-olds on YouTube telling us that
yeah,
they're driving Lambos and so on. But in all serious, there you can see sometimes people do make a quick buck, and if they can get in and out, fair play to them. It is hard not to feel that you're missing out. But I think the key, and I think I've said this a load of times, the key is to understand your own risk tolerance. What are you willing to lose
yeah,
in order to get that gain? And generally, these are more volatile. So yes, you could probably make money quicker than you can with dividend growth investing, but you can definitely lose it a lot quicker as well. And I think
yeah.
that's the main thing that keeps me grounded.
Yeah, and I think also just again being surrounded by people like yourself and such also helps a lot. Yeah.
Yeah, yeah. Lloyd has asked us, what are your thoughts on Broadcom? As we mentioned above, they've
Yeah.
just hiked their dividend by 12%.
Oh, I find this one a difficult one. I've looked at this company several times. I just don't like the management style. But honestly, this company just keeps on growing, growing, and growing. So there's nothing bad I can say about it. It just every time turns me a bit off when I start reading their information about them. Yeah, I mean, if you even look at their margins, I think their cash flow margin is like Dividend Wave put a picture on 50% compared to, for instance, what is it? Texas Instruments of 15%. So that's like triple difference. Yeah.
Wow.
So I don't know what the company's really doing. Maybe it's just, yeah, I don't know. It sounds sometimes too good to be true.
Yeah, I get you. Radu has asked us, what tools or sites do you use to estimate the evolution of a DGI portfolio?
Yeah, so Radu, maybe what is good to mention, if you go to the europeandgi.com, to my blog, you can find there under the menu item resources, you can find the calculator, retirement calculator, and that's what I use. So it's a G sheet, you can copy it for yourself, and then you can put in your criteria, and then you will see like how it will grow and how much dividends it should spit out. It takes taxes into consideration as well. So this allows you to calculate your own how is it your own journey up front, and then you know what your plan is, and then the hard part starts because then you need to stick 15 to 17 years to the plan.
Good. The Dread Pirate Prophet asked us, what plans have you got for the show in 2023? So at the moment, we don't really have concrete plans. We will be discussing it over Christmas. There's obviously a list of people we would like to invite into the show, so we have to contact them. We tried really hard to get Sven Carling on the show. Unfortunately, we're still too small, so we have to help grow this community, and then we'll finally get him on. But um, we'll see. We'll discuss it over Christmas. But like always, we'll try and push it, try and grow it more, and get some good guests on for you guys as well.
Nice.
Le Collector, the Dividendes, has asked, are you planning to buy some shares as Christmas gifts for your kids?
Yes, not only for my kids, for all the small kids in our family, so the cousins as well. I did it last year for the first time, and this year I will do the same again. And I want to give them a stock that they would recognize. So I'm maybe thinking about Google. I mean, even the kids know Google nowadays from Android or from just searching stuff. So I was thinking maybe about those.
Nice. I will put money into their account, but I will let them pick their own
Nice.
companies, just so as they have some say in it.
Yeah. So what I do is I actually create stock certificates. Yeah. So I
Nice.
really create them, print them, and then put them in an envelope.
It's
And
way too
then
much
when
effort.
they are 18, they can give them to me, the certificates, and then they can turn this into money.
Nice. That's way too much effort for me. I just they can just go online and look at what they have. But no, that's awesome. That's a good idea. The next question is from Jara Saren. Have we got a fair value on ABB?
Yeah, I think we just looked at our dashboard, right? I think it's 19 Swiss francs. I believe it's trading around 28. So for us, it's overvalued at the moment.
Yeah, still a little bit overvalued, but still definitely a company I would like to own. And a follow-up question is, what 5 stocks would you buy today if you started on Monday with a new portfolio?
Ooh, that's a difficult one, but I would definitely go for something like Ahold Delhaize, just a consumer staple in there. I would probably go for Realty Income, a real estate investment trust. I would go for pharma company, maybe still for Upfi. Yeah,
Yeah.
those three, let's say, come first to mind.
I I would probably start out with Johnson & Johnson in pharma over AbbVie. Realty Income, I think, is is a certainty that
Mm.
has to go into most portfolios. After that, Texas Instruments will be there
Oh, yes.
along with Microsoft. And do you know what? I would probably put my fifth company into Intel
Mm. Just
or
for some
HPQ
upside potential.
or HPQ, Intel or HPQ,
Yeah,
one or the other. But
nice.
that's what I would start with. Next question is curious about your watch list. Perhaps you guys can share your top three.
I would like to buy some more HPQ and Viatris at the right price. I would like to buy some ASR probably, Dutch insurance insurer. I have already a small position, and I just bought some targets. So for the first time ever. So maybe if it dips further, I could buy some more.
Nice,
Four,
nice.
four. Mhm.
I'm still looking at HPQ. I really like him at these prices. Dipping back into Intel slowly as well.
Yeah,
They are they're my main two this month.
yeah,
But I will sit down. I get paid this week.
nice.
So I'll sit down and make some decisions. But the HPQ is really standing out to me at the moment.
Yeah, I bought some HPQ I think 2 weeks ago, and also some Intel with the Castellum house hit capital that
Yes.
I got.
Yeah. Okay. Keep Walking has asked your opinion about Germany.
Yeah,
Germany
Jeremy
Martins, I think.
Martins.
Yeah.
Yeah,
Yeah.
they own Biedronka in Poland. Unfortunately, I haven't been able to look into the data, so it's something I will need to get back to another time.
Okay. Dividend Gardner has asked what do we think of the bank CEOs in the US claiming that a serious downturn is coming? Are they lowering the ball for their own performances, or is this a real serious signal that we should be taking into account?
Well, it wouldn't surprise me at all. Not at all. If you see what inflation is doing to people's savings and pockets, even to our own personal finances, right? It's real. If I just think about people suddenly going in Poland from a what is it 2% interest rate to almost 9-10%. I mean, and they are leveraged to the tits. Some of them. That I am not surprised at all. The question is how it is priced into the stock market, and for that I can't really tell you. But like a
Yeah.
consumer recession, yeah, definitely, I can see that coming.
I,
If
I,
it,
I
it didn't
don't
already start, yeah,
Yes, yes, if it hasn't already started. I don't think they're lowering the ball for their own performances. I think we all
no,
know they're going to be pretty poor anyway. Um, it, it could be a sign, like as you said, we could be already after starting. Who knows? But history doesn't repeat, but it often rhymes, and you just need to look back of when the last time we were in this and how the stock market performed, and it wasn't pretty for a while. It
no.
took maybe 10, 15 years to even actually come out of it. So it could be, but we are dividend growth investors. We're not investing in share market price. So it will hopefully create some really good buying opportunities in companies that will continue to grow their top line, their bottom line, and pay us dividends. So that's the
And
hope.
our projected annual dividend income even quicker.
Yes, yes. I might reach financial freedom in 9 years instead of 10.
Exactly.
A question we get quite a bit: does FX impact change your investing style? As a UK investor, it's making me think to invest more in my own country than in the US stock market.
Uh, Of course, it influences me, but I'm trying to tell myself not to be influenced by it. So I had over the summer that I was buying a bit more European stocks because naturally I started to look into that when you see the euro dollar going from 120 to 1. But lately I started to buy American stocks again a bit more because who knows where the stock market or the FX will be in a year from now. Maybe it will be at 80 cents. So yes, it does influence me to some extent, but I try to ignore it because in the end, it doesn't really matter when you're dollar cost averaging.
Yeah, it's hard sometimes. I mean, we had a show, didn't we, when the pound was crashing? It
Yeah,
created some really good
yeah,
opportunities for us. So sometimes it does impact, and I wouldn't say change, but it just makes you focus in a little bit more of one
yeah,
area over another. But overall, I try and zone out. I'm not really an expert in that zone. A lot of
yeah.
things can impact FX. If I was that good, I would have made money when I chanced trading that a long time ago. But I try and, as you say, dollar cost average and hope and pray that it evens itself out over time.
Yeah.
And then the last question then is from, I know two more. Doris has asked us, do you take the current or future local global regulations into account when buying or selling stocks?
Not really. If I look at taxes, I look at the yield after tax. So yes, I do take it into account, but I look at the pure yield after tax. Other than that, not 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 really, not really. No.
Yeah, I do have to say tax comes into it. It's pretty much why I'm not investing in Swede, Swiss stocks, because the tax is so high and my investments are so low. I'm never in a million years going to claim that back. I know you keep preaching and telling me yield on cost, but it's a mental barrier for me paying that much tax.
Yeah.
So I do take that into account. Price caps, subsidies, not so much. The second part of this question was, do you consider moving to a country with lower taxes, lower cost of living now or in the future?
Well, I've got two kids, which makes it hard. But sometimes I daydream of living in Portugal. I believe for foreigners, when you get there for the first time, and you would, let's say, take a job as a digital nomad. For me, it means I'll put every week a YouTube video on. I believe you will pay off the first 10 years no dividend tax. That's my understanding. Now, imagine being in Portugal with the weather. I just don't know what to do with the kids then. Yeah,
Yeah,
that's my
I mean,
issue.
my wife would not in a million years move from Ireland, so I'm stuck.
Yeah.
I'm stuck here. And as you said, kids, family, it's hard to up and leave. You
Yeah.
build your whole life somewhere. You've lots of
Yeah.
friends, you've lots of family, so it's hard to just get up and leave. There's
Mhm.
more to life. There's more to life than just paying lower tax. So
Yes.
um,
True.
the answer for me is no. And then the last question is from the Catalan Dividend investor. Do you see regulatory risk with breweries? Do you consider them part of sin stocks?
Um, I think there is something, but I see more regulatory risk, for instance, with the big tech at the moment than with beers. Politicians like beers as well, and they don't want to see, for instance, I don't know, a dead liver on a beer glass before you drink it. Yeah, like what we saw with tobacco stocks. So, yeah, I think generally, um, everything that could harm people brings risks, and beer is probably in that category, but I see it as limited risk compared to some other harmful products.
I would agree, and I would also say that there is a growing trend. They are aware of these trends. People trying to be a lot more healthier and not drinking as much. So now they're releasing these 0-0 brands because people still like the taste, but they don't want to drink. And
And they're quite
there's
popular in my environment.
they are getting popular all over. And I think I've read there's the expected growth rate is maybe 5-6% a year on
Oh,
these. So it's going to be something quite big. So I don't see the risk too much. Do I consider them part of sin stocks? Yes, they are technically a sin stock. Like you said, anything that can potentially do harm, even though it's fun while you're doing it, is a sin stock. So it is. But
yeah,
I don't see the risk too much. As the only risk I saw at Carlsberg is geopolitical in around what's happening. But once that goes, I mean, I see stuff like that weaning out. So yeah,
good, good, good. Hey, we came to the end of the show. I believe if you made it so far, it means you don't drink alcohol, because I cannot imagine. Otherwise, you would have stopped the car or wherever you are, stopped running. You would have gone into a pub or into a supermarket and bought a beer. So, guys, you rock. Keep on running, keep on driving, hands on the wheel, and see you next week again.
see you all next week.